Hi there and welcome to Money Managers, a User's Guide. I'm Nathan Peters. I decided to do something a little different for you guys today. Typically I'll feature a specific money manager or a suite of funds to go through how those stack up in terms of value for money. But I thought that today I'd explore what a specific type of investing looks like, and it's sort of a hybrid between active and passive management. I'm talking about factor investing. Investors have invested in factors for eons, but only in the last couple of decades has the practice gone mainstream to the point where you see very large asset managers such as Dimensional and AQR investing largely in factors, to the exclusion of discretionary processes entirely. Factors were initially defined and tracked by academics and data providers such as Barra in the early days of computers, which allowed investors to rank and sort the large universe of stocks into subsets that exhibited certain characteristics like low book value to price in the case of value stocks, for example. And crucially, these factors take market risk and idiosyncratic stock-specific risk out of the picture, allowing investors to gain pure style exposure. Many different data providers have come up with their own factor libraries, and Venn's factor library is one that figures prominently in the analysis we feature on this channel. But insofar as these factors have been built in a proprietary manner for profit, their proliferation has gotten a little ridiculous, to the point where millions of factors have supposedly been identified. This Tower of Babel doesn't serve the investor community very well, and it becomes difficult to apply factor investing in practice or even understand what risks a given factor carries with it. On the side, Venn has limited their factor library to 18 factors for this very reason. All this is a preamble to a heartening development for investors with the announcement of the Bloomberg GSAM risk premia indices last month. Now, I won't go into detail on this. You can find the info on their website, which I'll include in the description below. But for me, this series of 21 factor benchmarks were developed in consultation with large investors to solve a problem, which was the lack of transparency and replicability in existing factor indices. The genie is truly now out of the bottle, folks. We've defined the playing field in factor investing, but now the real question is, do we like the game? Well, let's turn to Venn and see what the boffins at GSAM and Bloomberg have come up with. For brevity, I'll just look at the 5 equity style factors in this video, which are quality, momentum, value, low risk, and multi-factor. And right off the bat, we can see that they didn't optimize for Sharpe. The best risk-reward ratio they constructed was a 0.4 Sharpe in quality from May 27, 2007 until now, and the worst is a horrendous negative 0.5 Sharpe in value. If we regress these factors against the Venn factors, we see that they're generally in agreement and market neutral, which is key. They're also lowly correlated to each other, which should help in portfolio construction, right? Well, let's put them all together in a portfolio and see what the results would have been. Well, you get a big fat 0 in terms of Sharpe and a volatility of about 4. Venn assigns some risks to their own factors here, but the majority of risk is unexplained here. And all that unexplained risk taking ends up losing money here. So it's just not desirable. If we run this over 3-year time windows, though, we see the telltale signs of a non-data mined backtest. A strong alpha up till about 2015, followed by negative and worsening alpha, presumably as the factors they defined were discovered and arbitraged away by other market participants. The cumulative residual return graph, which always makes my day when I see it, shows this development in stark fashion. Perhaps these transparent, replicable factors aren't such great investments anyway. Perhaps they're better left to just describe the kinds of risks that other managers take. Well, if you've made it this far with me, I can now get to the point of the video's title and the implications of our findings for the man who solved the market, Jim Simons, founder of Renaissance Technologies. For those who don't know who I'm talking about, there's a great book out there where you can read all about him, link in the description below, and I believe he is now the richest hedge fund manager alive with a self-made fortune of about $24 billion. And by the way, investors in his fund have made about $100 billion. So crucially, he extracted most of that return from the market, not via fees. And this is from a relatively small fund that has been closed to external managers, external investors for 15 years. It is the legendary magical money tree that academics don't believe can exist and a direct refutation of the efficient markets hypothesis. When that magical money tree closed to external investors, you can imagine that they clamored to have Rentec manage money for them anyway. And Jim Simons made it his goal to design an investment process that could apply their best ideas on a scale large enough to manage $100 billion, or real money. The result, the Renaissance Institutional Equity Fund, or REIF, is one of the great experiments of modern money management, and it has been running live for the past 13 years or so. It is a private fund, and the returns are not publicly available, so I'll only describe what I was able to get from commercial databases, and I'll get straight to the punchline. REIF looks a lot like a combination of those equity factors we've been discussing. In point of fact, it looks like quality plus low volatility plus 40% exposure to equities. About a third of the risk is unassigned, which, like in our portfolio of generic factors, also goes unrewarded. The difference is, although the returns of REIF are significantly better than those of the generic factors, truly 100% of the returns can be assigned to those three factors, consistently throughout its life. Now, this has huge implications for a lot of people, especially the investors in REIF paying fees on their investment. But for me, it proves one of the truisms of the market that I live by, which is that size is the enemy of performance, period. Thanks for making it to the end of a special extended edition of Money Managers, a User's Guide. If you found this content useful, please like, comment, subscribe, and hit the bell for notifications on new episodes every Friday. Till next time, use your money managers. Don't let them use you. Thanks.